I think we should distinguish what is venture capital, what is PE, what is the angel fund.
I keep joking, the only person you're responsible when you're angel investing is your spouse, right? So there's no institutional responsibility. It's your money. When I was doing research around starting Blume, the US had 300,000 registered angels. So I feel like 95% of them are like part-time, pastime. So they have made money as entrepreneurs or whatever it may be, or as professionals, and they like to help out someone. So it could be their colleagues, friends, children, whoever, and that's also angel investing. Then they join networks, they put a little bit. About 5% of them become sort of professional angels. They actually think they can make money off this.
What is the quantum which you would say is angel? Like if I'm investing 10 lakh rupees in a company?
Sadly, in India now, people are raising 1 lakh through various mechanisms. I find it super dangerous.
So what is the upper limit of angel?
I've seen people put 1-2 crores.
1 to 2 crores.
Yeah.
So let's say that is the peak that we would categorize as angel investing. From 0 to 1 to 2 crores.
I think the characteristic of the person putting the money is more important.
Would
When
you
we
say
started, angel groups used to take 5 lakhs, 10 lakhs. Now it's got so democratized that people are actually hunting tier 3 cities and getting 1-2 lakhs in a syndicate of 2-3 crores. It's good and bad. You're diversifying somebody's capital at that stage, but I don't think they know what the hell they're investing in.
So I have many friends who do a lot of angel investing, like hundreds of companies, tiny check sizes. Would we all say that the odds of making a return net is least in angel investing?
You said easiest?
Least.
No, not at all.
Hardest.
I think 90% do pretty badly. From what I remember, the US stats back then.
90% of angel investors lose money?
Not lose maybe, but their returns will be pathetic.
But isn't that a factor of the deal flow?
Absolutely. Absolutely.
I mean,
But I don't think we can get specific here. If you were to add all the angels and all the deals I'm talking
The
about.
reasons are that, but
I mean, if you...
they really don't know what they're getting into.
Yeah.
And it's adverse selection. Today, they'll come to Prashanth, Rajan and me, if they're really that good and pick up $1 million, that's your best entrepreneur. Why would you touch angel money? Or why would she touch angel money?
So I'm not talking about those 1-2 exceptional angels who have a distribution network by virtue of fame. I'm talking about anybody investing 1 lakh up to 1-2 crores. I'm adding all the deals they've done together.
No, that's what the thing is. I think as an angel investor, the best odds is to invest in something where your value is not the money. Because if it's only money, they'll go to VCs and raise the
But
money.
he's talking about a professional angel.
But you're talking about the exception to the rule, not the rule.
95% will be mediocre returns.
Yeah.
5% will do well, of which I think 5% are legendary.
Correct.
I mean, I would even go further to say, if your objective is to make returns, you should not be an angel investor.
Yeah. My perspective in all of this is to talk about making a return.
Yeah.
This is not about learning about the ecosystem. You know, we all do that. Like sometimes we play a certain game and lose a little bit of money and then we say it's to learn about each other, team building, all of that, right? This is not one of those things.
Yeah, so I think if your objective is to make returns, being an angel investor, unless you really know what you're doing and you're deeply networked and you can add tremendous value, is not a good idea.
But I'll qualify it, right? So, because I don't want to make it look like angel investing in general. See, if you have a sectoral experience, right? Let's say you are from the FMCG industry, you understand retail very well, you understand how brands work very well, you've been in HUL for 15, 20 years, right? I think you will...
No, 100%.
So I think it depends on who the angel is.
That's right, and where you have to add value.
I'm not saying that. If I am Sachin Tendulkar and I know I'm Sachin, I should be playing cricket and I would do very well. I'm saying if the city has 100 people as the population of the city, if all 100 play cricket, what are the odds of them doing well?
If you want to angel invest, right, and you want to do it for returns as opposed to giving back, or you just want to get to know entrepreneurs, then I think to Prashanth's point, you should really figure out how will you add value, right? So in the case that he mentioned, you know, you should be investing in consumer brands where you can add a lot of value. Over time, your reputation builds. So
who are you adding value to?
To the founder.
To the founder.
To the company.
Because he gets early early
Access.
like access and a kickstart, which otherwise for him he doesn't want to go to an institution fund like us day one, right?
Agreed.
In many
Like
cases.
when we invest in seed stage, right? We're always looking for a few angels who can add value to our companies. In fact, last week we just invested in a consumer brand, and we were looking for 1 or 2 angels who have experience in that sector, who could, who are not conflicted, who can add value. So we will get 2 or 3 angels. And so that is where you want to be, right? Where you're those, whatever,
Yeah,
10,
I agree,
15.
I agree. When it comes to adding value, I agree. But blind capital,
No,
blind
blind
angel,
capital, I think on
That's
the
what we're
odds
talking
of
about. That's what we're talking
returns
about.
are
Yeah, it's
least
going to be
when the
no different
investment
from-
size is between 1 lakh to 1 crore kind
But
of thing.
that said, they're very important for the ecosystem.
100%.
They will take risk where institutions can't step in yet. Somebody has to support these. Friends and family money runs out. First round is friends, family, fools. But basically that runs out. And it's even smaller in quantum. So if you want crazy risks, somebody has to take those risks. And sometimes angels step in.
Sorry, how big is the Indian angel market?
About 6,000 of them.
6,000.
6,000 active angel investors.
I've
That's
heard
about-
even more now.
Right.
I've heard some shockingly large
How big?
numbers. More like 25,000.
25,000.
And US you said is 300,000?
15 years ago.
15 years ago.
I'm
We have a
looking at
long way to
2008
go.
data.
A long way to go.
Yeah, yeah.
And in the US, do you have to be like an accredited
Yeah.
investor to angel invest? Okay.
Here you don't.
2 lakh is the angel fund route. I think you need to minimum invest 2 lakhs. But you can get even a guy with 10,000 rupees on the cap table, I think, right? There is no such restriction.
There's no
Yeah,
restriction.
there's no restriction.
Okay, next, venture capital.
Yeah, so angel investors, you're investing your own capital in a very, very early stage company. Usually you're just starting up, you pre-launch, whatever, right? Venture capital is basically institutional capital, where these are organized fund managers in a firm. So let's say PeakXV or Accel or Blume, where you raise capital from others.
Above what number would you start considering yourself a venture capital firm?
So I would say a growth fund would invest maybe up to 50 million. So from a few crores per investment up through 50 million. So
Fund size, you're
400
saying
crores.
50 million?
No. I'm talking about per investment.
No, I'm talking fund size.
No, so fund sizes can vary from $20 million to, our last set of funds were 2.85 billion.
20 million is the bottom level for...
10 million India? What is it?
So I think
A
in
fund.
India now
10 million?
micro VCs are as small as 5 to 10.
Okay.
But that's because the first time manager is raising from individuals, not from institutions. So is actually raising a mega angel round and calling it a fund.
And is that through a Cat 1 or 2 AIF?
That's correct. Cat 1.
Cat 1 AIF.
So 100 crore. Like you have a
Okay.
lot of micro funds that start at 100 crores.
Before we go into this a little bit deeper, what is the AIF? What is Cat 1, Cat 2, Cat 3? Who can take that like very quickly?
The government didn't know how to regulate all of this. So in 96, they started something called Domestic Venture Capital Fund Regulations. Everybody was classified under that, whether you were private equity, real estate, or venture capital. And they realized that that was a crappy way to deal with the complexity of these many asset classes. Because now you're asking us to break it down. The government hadn't figured that they needed to be broken down. So 2012, they revised it and called these regulations AIF regulations, Alternative Investment Fund Regulations. So basically now they can regulate us basis what kind of risk we take. So Cat 1 cannot invest in certain securities like debt, etc., public markets. Cat 2 can, and Cat 3 is only public markets.
So who is typically, which
Venture
category?
capital is Cat 1 and 2. Private equity is Cat 2.
How do they decide between 1 and 2?
Basis what securities you can buy. So if you're only doing equity investing and you don't touch private equity investing and you do not touch the public markets and debt securities, then you can be a Cat 1.
Perfect. Back to venture capital.
Yeah, so venture capital is, so think of it as this is institutional capital. So it's organized teams. It's not an individual's capital.
So it could be as low as 5 to 10 million?
Yeah,
all
so a
the way
small
up to
fund
like
could
billions.
be small fund could be 100 crores. Large funds could be 25,000 crores, 30,000 crores, 50,000 crores. In the US, the large funds are, the largest fund ever raised was the Vision Fund, which is $100 billion from SoftBank, right? Although that was probably a hybrid venture plus growth, pseudo private equity. So the simplest way to think about it is, venture capital is organized institutional capital that helps you get off the ground. So it could be for a now individual company, could be the 2 to 3 crores that you need to get your company off the ground, to funding your next round. So there's different stages, seed, we can get back to that, seed, Series A, Series B, Series C, up through a company that gets to a level of profitability. And then either, there's a mixed term will be interchanged between growth capital and private equity. We'll take on from there. But private equity really then is once you're a established, mature company. So you're
Now, we'll get into
generating
private
profits.
equity, but venture capital in itself, can you give us some examples of 5 most popular ones in India?
So, companies, there are probably 10, 15 very well-established firms. So Blume, companies that are sort of domestic.
Accel
would
venture?
be Accel. Yeah,
Accel
we're all venture. So Accel, PeakXV, Lightspeed, Nexus, Elevation, Blume, Chirate, Kalari, Matrix.
And would you like to say a little bit about the fee structure in venture capital and the life cycle of venture capital of a typical fund?
Most venture capital firms are 10 years with a 2-year extension.
7 or 10?
It's 10. 7 I think is
There's no
unusual.
point going below 10.
It's very hard because, that's why, right? Because you're funding companies before they
in
launch.
most cases, they have a 2-3 year extension option.
So think about it, 10 plus, you have an extension period where you can extend the fund. The fees usually are 2% of the funds that you raise are used annually for management fees. That's what you use to pay your teams and so on and so forth. And there's a term called carry, which is the percentage of the gains that the fund managers get to keep. And that's 20%.
Is
so you'll
that
hear this,
on closure or is that like
that's on distribution. So basically you have to exit a company, right? So the way you can exit a company, there are 3 ways you can exit. You can take a company public. You can sell to a strategic, right? So let's say Google comes and buys one of your companies. Or a later stage fund can buy out your stake. So those are the 3 ways you can exit a position.
And would we largely say that venture has returned a better return than angel in the last decade?
I don't think we have data in India to show that.
But
it's
if
fair
you
to
were to
assume.
extrapolate into
Yeah,
the
it's fair
guess.
to assume. It's fair to assume.
When you said on distribution you get a carry, what happens if you invested in 10 companies, you're sitting on 9, you don't know what the value is, and on 1 you had like a multi-bagger. Now you're distributing the profits of this. Can you take 20% of the profits?
It's classic what's called European waterfall, American waterfall.
Right.
So you don't get deal by deal. It's very rare. That happens in very exclusive funds which are doing large private equity, single transaction deals where you can actually take carry by the deal. Here you are not entitled to anything until you've returned not just the capital that you invested in totality, but also the fees you consumed during that 10-year period. You return that too. So basically you take $100, you only get to invest about 80. The other 20 is going in all sorts of expenses.
Got it.
So you first return the 100, and then there's usually a threshold IRR rate, which is compounding from day 1. That for a fund like us, emerging manager, we have asked to give 8 to 10% as a threshold.
Right.
We can catch up after that. What it means is I'm not denied my share of those profits, but I have to first pay back that much to the investors. So 10 years down, I've returned $180. I have not seen a rupee.
Of carry.
Interesting.
Right? So to get $180 off that 100, even if my top 3 companies get there, it's probably taking 10 years. And even after that, I'll probably be left with 2-3 stars, and I still haven't seen a single rupee of carry. It takes that long. So the incentives are aligned to kick your backside really hard, to work really hard, to get to that point before you can actually see any money.
Got it. Now, the second question, you had said dry powder earlier, right? As in the term was...
This is the term that's used internally in the industry.
Now, there's this whole debate running, right? As in how much of this dry powder do you have access to? I mean, how much is the money that's lying with you and how much is that you can call for? So if Sequoia, or PeakXV, you have $2 billion of dry powder. Is that $2 billion sitting with PeakXV?
No, it's committed and you call for it. You don't want to call it all and then invest over many years because it impacts your IRR.
The IRR counter starts the minute the money is wired
the money
into your
gets
account.
you.
Oh, so you, okay.
So you never touch that money.
Right.
It has to, better stays there.
Right. But what if the person backs
So
out?
Nithin, the institutional investors, once they commit, they don't.
Reputationally, they have a even bigger reputation to protect than we do.
Another interesting question. What proportion of your limited partners where venture capital is getting their money from are institutions and what portion are family offices and stuff like that?
See, in our case, it's like 90% is institutions.
Mostly?
Ours is 100. We don't have any family office.
Right.
We don't have any HNIs. We don't have any corporates.
I would say 50-50.
Why is that different? Because you're raising money from India and they're bringing from outside?
We're still not considered good enough for all those.
So let's say with scale, venture becomes more of an institutional play.
Yeah, you raise
Yeah,
institutions.
because you can't raise that kind of capital from small investors. That said, I remember having a chat with Tiger as late as 2014-15, and they would still reserve a little for people who backed them in 1991.
No, they all have a small
Corpus.
allocation
And
Makes
for
sense.
they say
family
you're a
offices
loyal
because,
investor,
yeah.
I'll give you the right to keep investing.
Makes sense.
The fund cycle is 10 to 12 years. But most term sheets are typically 5 to 7 years, isn't it?
I think
7 years.
From an
is-
exit requirement?
Yeah.
But you don't really exercise that.
But you will have some powers, right?
Yeah,
as
there
in-
is an
we do, but
opportunity
we
to
don't, yeah.
exercise,
Right.
But we don't.
It's not.
Because keep in mind, this business is a power law business. What that means, it's that few companies that really return. And we all know that, it takes, now some companies will.
Right.
Like growth stage investors, right? So if you're, let's say, investing 50 million, so at PeakXV, we have 3 teams. We have a seed team, surge team, venture team, and a growth team. So the growth team can. So you invest 30, 40 million in a late stage company. 2-3 years later, the company goes public. So within 5 years, you could exit.
I think the two elements, I think this entrepreneurs misunderstand VCs. Intent is, we'll never make money if you don't make money. Okay, so incentives are aligned. It's not like I can make the money, run out with the money, and you stuck there. Right? Broadly, there is incentives to be aligned with you. So nobody will kill a golden goose on a basis of a term that's written there. However, you don't want to misalign incentives and say, oh, you have 10 years, number one. Because invariably, entrepreneurship is such a tough journey that if I say you have 10, you'll take 15.
Right.
That's point one. Point two is you're underestimating the fact that my checks are written all the way from day 0 to year 5. So I'm writing follow-on checks. I'm writing fresh checks on the last day of year 3, right? And my term life is fixed. So I have to apply the same principle everywhere. Right. So the last check, just because it's the last check in the fund, I can't say, screw you, I'm going to give you 7 years. Whereas because you were the day 1 guy, I'll give you 10. So you establish a set of standards that work broadly amongst all of us. And so Accel doesn't have a separate set of terms than I do and vice versa. And it doesn't matter whether I'm the first year of the fund or the third year of the fund.
And that clock sometimes get reset.
Oh, okay.
On the basis of a new round.
New rounds. So it's really...
And these are typically close-ended, right? Venture capital funds?
Almost always.
Okay. P, would you like to take it?
None of us are P here, but just to take off from where Rajan was talking about, I think what late stage venture and P, I think there are a lot of similarities between these two. But P funds are exclusively raised as PE funds, right? So typically,
Sorry, what does P stand for?
Private equity. And by the way, from a classification perspective, sometimes it's confusing because this entire class is called PE.
Private equity.
Private
is
equity.
private
We're in a
equity.
spectrum
We're in
of
a-
risk.
For scale, is there a differentiation in scale between VC and P?
I think it's less about scale. I think it's about time to exit. They like to come in closer to when there is visibility to an IPO event 2-3 years or an exit event 2-3 years. I think their horizons and their windows of how long they want to hold is very different.
Very different, meaning significantly shorter than VC?
Much shorter.
Much shorter.
Much shorter.
Because they're coming in a later.
They're coming in later. Their expectation on the maturity of the model and this product market fit that he was talking about is much more.
Yeah, night and day, yeah.
Yeah, so they really expect...
So you're saying Ps are more conservative historically than
Yeah,
VCs?
Correct.
Because they also deploy invest more capital.
So we had this number that VC AUM in India is 60-70 billion, of which 90% is foreign and 10% is domestic. The P number is about 200 billion, in which 85% is foreign and 15% is domestic. If you had to extrapolate and give a rate of return that P achieved versus VC achieved, who has done better in the last decade?
I think the PE industry has been around for slightly longer. I think...
Is that another way of saying they did better?
I think because they've also been in multiple sectors which are not tech only.
So top quartile, there might be some outstanding funds out there which have done probably better in terms of cash returns.
Net.
Cash returns.
Yeah.
They're ahead of us.
They're ahead.
Yeah, in cash returns.
No, it's also, I mean, from a vintage perspective, they've just been in the ecosystem longer.
They've had ups and downs. Post 2008, they were a terrible asset class. And then in the last decade where we have been growing but not returning cash because the exits haven't come. A lot of people say that PE has done most consistent. They've been more consistent.
Okay, source of capital, you said for VCs it is 90% institution generally, 90 or higher. You're different because you're more domestic in nature. Where does PE's source money come
Sources
from?
are pretty similar.
About the same.
I mean, about the same.
Same?
Institution.
Yeah, some domestic PEs are over-indexed on Indian family offices, etc.
Yeah, but yeah, few.
But it's a little like the venture space. But if you go to a person who raises predominantly overseas, it'll be entirely institutional.
Okay,
Because the check sizes are even bigger.
Popular Ps, 5, which Indians have heard of.
They would be, I would say,
KKR,
Multiples?
Carlyle,
TPG?
or domestic. Yeah.
No, forget the overseas ones. Even in
Oh, in
India, I
India,
think we have multiples. Kedara, Chris
and
Capital
Chris.
have done exceptionally well. And then there are a lot of global names like them. So
KKR, Warburg.
I think we got a clear understanding of the difference between angel, VC and PE. Hi, I'm Nikhil Kamath. I'd love to know what you thought of the episode. Comment, like and subscribe, and thank you for watching.